Let's talk about the no landing, no rate cut scenario. Bob, I take it you're a little bit less keen on joining the no rate cut camp today.
Well, I think the main thing to focus on is the ordering, because the ordering of market conditions is going to determine the Fed's policy. And the way that I describe it is until bond yields rise, the Fed is not going to cut. And the reason why that is that under the current interest rate structure, this economy does have an incredible amount of momentum. Asset prices are reaching new highs. Employment continues to chug along. Income growth is strong. And so what interrupts that cycle is it doesn't just fall on itself. What has to happen is we have to have a rise in bond yields. That rise in bond yields has to start to slow the asset price appreciation, and that has to start to shift the amount of demand coming from consumers. But the ordering matters. So that's why I like to say until rates rise, the Fed will not cut.
But Bob, the rates market has retested near-term highs without any demonstrative hit on the equity market. So are you talking about a more extreme pricing in bonds to the upside?
Yeah, I mean, just think about, if you just go back last summer, what we saw bond yields rise up to 5, and we only got a modest equity correction in response to that, and not nearly enough for long enough in terms of the rate rise to create a drag on the economy. Now, fast forward, we're basically 9 months later, 6 to 9 months later, and asset prices are reaching even higher levels. There's even more positive momentum in the economy. We're seeing actually cyclical upticks in areas like manufacturing, global exports, et cetera. And so in order to get that slowing, at this point, we probably need to move yields back up to the 5 or even higher in order to slow the economy.
Bob, you're sort of trying to give people a little bit of a heart attack here.